All right, to elaborate on some of the terms you're going to frequently hear us talk about, we'll start with gross potential rent.
So gross potential rent is if the property is 100% occupied, it is the max amount of money that the property is able to generate.
Yeah, and then expenses. Obviously we have our income. The property there's bringing in through the rents, the amenities. Now we have our expenses, which is going to include our operating expenses, and that's going to include property management, repairs and maintenance, landscaping. If we have an on-site property manager or leasing agent, really anything that goes into the day-to-day operations of the property. Our non-operating expenses being more of those, expenses that come up not regularly. That could include resurfacing or repaving the driveways. Maybe that needs to be done every 20 years. But if we were to put that in 1 year under repairs and maintenance, that would completely kill the deal. And so the non-operating expense is going to be something that we're taking out on typically a per unit per year basis, so that we don't incur that $50,000 driveway expense on year 10 and say, oh, we haven't put any money aside from it. And so that'll be underwritten below our net operating income, but we're going to take out money every year for those larger expenses that happen every so often and budget for them. That way it's not so detrimental. And so that comes out below our net operating income again, but it does affect our cash on cash return for ourselves and our investors. And so, to calculate net operating income, do you want to expand on that?
Yeah, so net operating income is calculated by your gross potential income minus all expenses. So all your expenses don't include your debt service, which is the mortgage on the property. And so that leaves you with net operating income. And then you have cash on cash return. Like anything, whether it's a stock, your return, your cash on cash return is based on the money that you make every year divided by the money that you have in the deal.
Right. And our average cash on cash return is again determined by, say, a 5-year hold period, and you're getting a 10% return for year 1, 2, 3, 4. Year 5 we sell the property and now it's a 50% return. You would add up those returns from those 5 years and then divide it by 5 years, and that's going to determine your average cash on cash return. To get a little bit more intricate there's the internal rate of return that we talk about, targeting a minimum 12% for our investors. The internal rate of return is essentially taking the time value of money and taking that into account. And so if your average cash on cash return is, say, 10%, or 20, say it's a little bit higher, it's 15%. And that's because on year 5, there was a significant sale that returned all the capital plus, interest. And that averages out to 15%. Well, the internal rate of return is going to look at, the time value of receiving that money on year 1, year 2, where you could have reinvested it and the opportunity cost would have been there. And so the internal rate of return might be 12.5% comparatively to the 15% average cash on cash. And so that's just, something that we'll dive into a little bit deeper on how it's actually calculating that time value cost, but something to look out for and, understand when we're projecting the returns for an investment.